Hello everyone, I'm Nikhil Mishra, founder of Setu Capital. Today we are going to be discussing another company which is transforming itself from a small cap to mid cap company, and it belongs to a very renowned and old group in India. So I have made a short presentation for that. But before moving on to that, let me briefly give you a disclaimer that discussion is for educational purposes. Investment and securities are subject to market risk. Consult an investment advisor. I do have a position in this company, and I'm biased, and I will benefit if the stock prices of this company move ahead. Now, this company, Kirloskar Pneumatics, belongs to the Kirloskar Group, who have a lot of other varied interest, more or less in the industrial B2B segment in India. They are a very old group and are into existence by for more than 130 years. We will be particularly concentrating towards Kirloskar Pneumatics this time, which is a compressor manufacturer. It is a mid-cap stock. There are some vital changes which has happened within this company, and it is slowly transforming itself from a relatively stagnant player to a high growing player which is into a very large segment and is a small part of it, and it has a lot of bandwidth of growing and gaining more market share. So let me give an overview. The company started in 1958, and it is one of the largest air refrigeration and gas compressor in India. So as you can see, these are air compressors. This is the refrigeration compressor, and this is the transmission, and this is the road railer which they have. These are the products which they deal with. To give you a data point, almost 50% of CNG stations in India are powered by Kirloskar Pneumatics. Every CNG station has a one out of two CNG stations have a Kirloskar Pneumatic um, compressor. They are also the market leader and have around 70% market share in the ammonia refrigeration category. As the managing director of this company used to say, that people don't realize that how many places they do come across products which are made by Kirloskar. This company currently has an order book of around 1300 crore plus, and which has mainly come from the export opportunities which have arrived from Middle East market. These Middle East market historically have been catered by European countries. Now, due to the ongoing inflationary scenario in Europe, and due to the supply chain bottlenecks, etc., these European countries are not able to cater to the Middle East market with the same pricing power which they used to have earlier on. And that's what Kirloskar has found an opportunity, and there is an order book. And this particular products which they have are very important. You can understand that these products go into oil and gas industries, and there is a long gestation period through which all the checks and balances have to be maintained and checked. There is a long gestation period cycle, after which a product is approved and then gets into the gets into the assortment of these importers from Middle East. So globally, these compressors have a turnover of around $25 billion. It's a huge market. Basically, it's more than 2 lakh crore market. Indian market itself is of around 2000 crore, which is also catered by large MNC players, by including ABB and Siemens. So these are the products which they deal with, but they have a multiple products. But 95% of their revenues comes only from compressors, and that is going to be the case going forward as well. Not much and diversification is expected, and that is for the good, because the company believes that they are good in doing this and they have a huge runway for growth. If I look into the financial highlights, this is a very important slide, and there are a lot of observations which one can make. First one being that if you see that the sales from 13 to 22, March 22, the sales from 13 to 18 have been more or less meandering or being more or less constant, not growing at all. While from March 18 onwards to 22, there has been a rapid increase in sales. EBITDA margins have more or less been in the line of 14-15%, but they have started increasing, and they expect it to settle at around 18% in the next 1 or 2 years. After that, the management feels that uh, they will cross the bridge when we get there, when they get there. So once they achieve the EBITDA margin of 18% on a ongoing basis, then they will think of what needs to be done ahead and how much improvement they can make. The other next important observation is that the debt of this company is almost zero. See, 95% of the frauds are because of the borrowings which the companies have done and which they are siphoning or leaking away in some or the other manner. As soon as a company doesn't have debt, that says a lot about the balance sheet. You, you as an investor, you have, although it's a double-edged sword. Obviously, having a bit of debt reduces means increases your returns, return on capital and return on equity. But since many uh, many industrial groups or many group of entrepreneurs prefer to be not having debt at all because they don't consider it to be worthwhile of taking the borrowing considerations into account and the headache of regularly paying interest when they are self-sufficient. The net profit margin has been around 8 to 7-8%, and it is expected that it will remain in the similar range. There is not much changes which is going to happen over here. The company has recently done a capex of 93 crore rupees. Earlier on, earlier on, the company used to have a highest net fixed asset turnover of 6 to 8 times, and at present it is at 4.5 times. So there is considerable chance that that for some time they won't be requiring to make more capex because already there is not full utilization of the existing assets. Company's receivable days. So this being an industrial product, the receivable days are a bit higher. It's the industry-wide phenomenon. It is not just for this company itself. Inventory turnover is 4 to 5 times. So basically, they maintain around 70-75 days of inventory at any point in time. Return on equity is in the double-digit range, and as the asset utilization improves, it is expected that these returns are going to become better. Moving ahead. So, what are the observations? This company in the past 10 years has only grown by 6%. In the past 5 years as well has grown by 11%. But if you look at the trailing 12-month basis, you'll find that this has grown by 24% in sales. Operating profit margin has grown by 23%, while PAT has grown by 33%. So there is a growth acceleration. And as per management guidance, they are expecting to achieve around top line of 2000 crore in next 2 to 3 years, which gives us, as per my calculation, a CAGR of around 30 to 40% for the upcoming 2 3 years. The EBITDA margins are also expected to touch around 18%. It's not much improvement from this level. At present, they are at 17%. They wish to touch 18%. But there is a phenomenal change which has happened in this company's sales growth, and that is due to the opportunities which has arrived from the export, and also there is uh, there is a lot of push in the infrastructure segment, and they form a important part in the city gas distribution. The city gas distribution, which is the flagship projects, and uh, there is a lot of demand from the distribution companies while they lay down their tubes to transport gases. So there will be a requirement of uh, compressors as well. So this forms the tailwind for this company, and these are not the group of uh, uh, groups or people or promoters which keep on painting rosy pictures all the time. When they are doing or saying something, then it is important to observe and take note about it. They expect to double their turnover from 1000 crore to 2000 crore in next 2 3 years. That simply gives us a, CAGR of 30-40%, depending on when it happens. Coming on to the elephant in the room, the market and the early recognizers have taken a wind of it, and the price to earning ratio has moved to 27 and a half times on trading 12-month basis. Even if you look at other competitors like Siemens or ABB, they do have higher price to earning multiples, but that may be because of low float availability as well, because they are MNCs. In this case as well, there has been a minor re-rating of the stocks. The company has asset turnover of 6 to 8 times at, at its full utilization. At present, it trades at 5.5 times book, which is not cheap. I would say not at all cheap. A lot hinges on whether the company is able to generate the same sort of growth which it is highlighting. In that case only, there will be the management. In that case only, the re-rating will sustain. So this was an interesting company which we had discussion about. I hope you liked my discussion with regards to this. None of it should be construed as investment advice. Again, I'm reminding it. And in case you did like my video and observations, don't forget to subscribe and like. Do press the bell icon so that you will get every video which I upload. I mainly focus on small and mid cap and micro cap companies. And uh, do write in comment section that in case you wish to for me to look into any other company. But my only request would be that try to ask for analysis of companies which are relatively fast growing and are small or micro cap or mid cap companies. So in case any of you wants to take my investment services, do give a call. Some of us among my team members will contact you back, and do look into my past videos which I have created mostly into small and micro cap companies. A lot of hidden gems are there which if you look after 2 3 years you'll find that they might have appreciated in value. So thank you very much.